Hi everyone, we're going to be working in Financial Accounting Chapter 2, Measuring Business Transactions. We're going to focus today on learning objectives 3 and 4. In 3, we will look at the double entry accounting system and how it is applied to common transactions. And 4th, we will look at how to prepare a trial balance and describe the value and limitations of a trial balance. So let's start with objective 3, the double entry accounting system and some transactions. Business transactions require us to have some sort of documentation to record and recognize that transaction. Those documents are called our source documents, and they include invoices, receipts, checks, etc. that provide the details relating to a transaction that we will then record in our journal and record by entering it into our journal using a journal entry. The journal entry is just simply a recording of a single transaction in chronological order in the journal, and the journal is called the Book of Original Entry. It is where transactions first enter the accounting records. The steps in the process are to first record the date, then analyze and determine the accounts that are affected. That's where we would go back to looking at what we learned in learning objective number 1 with regard to the measurement issues of valuing, recognizing, and classifying our transaction. And then we would apply the double entry accounting principle to our transaction and record the transaction in a journal with proper debits and credits. We're going to go through now a series of transactions, and these transactions are further explained in your textbook on pages 99 through 105. So if you have any additional questions beyond what I go through in this screencast, then please feel free to refer to your textbook for more details. Let's first look at a transaction in which the owner invests in his business or her business. On July 1st, to begin the business, Tony Rossi files articles of incorporation and receives a charter from her state and invests $40,000 in her company, Creative Designs, in exchange for 40,000 shares of $1 par value common stock. As the owner, she invests in that business, and this cash investment results in an increase in cash and an increase in the common stockholders' equity. And so, as both of those accounts are increased, cash increases with a debit, and our stockholders' equity increases with a credit. So our rules relating to debits and credits apply. We have equal debits and credits. And we can journalize this transaction in a journal entry in the fashion shown here on this slide. Let's look at another transaction where we prepay an item. We prepay an expense using cash. On July 3rd, our company rents office space and pays for 2 months' rent in advance for $3,200. In this transaction, we have an increase in an asset, prepaid rent, so we're going to debit that asset, and we have a decrease in our cash, so we're going to credit our cash for the same $3,200. Our debits and our credits are equal, and we record this transaction as indicated here. Let's look at a third transaction. In this transaction, we're going to purchase an asset for cash. Purchase an asset on credit. On July 5th, we receive office supplies that we ordered on July 2nd, and we received an invoice for $5,200. So clearly, we've not paid this invoice yet. So we're going to record that we've received those office supplies. So we're going to debit our office supplies asset for $5,200 and credit a liability accounts payable for $5,200. The asset office supplies is recorded the increase in the asset office supplies is recorded as a debit, and the increase to our accounts payable is recorded as a credit, as the normal balance side for our liabilities is a credit. Let's look at another transaction. Purchase of an asset partly in cash and partly on credit. This would be a scenario where we basically put some sort of money down on an item. This is typically with bigger types of assets where we put some money down and then the balance we're going to pay off over some period of time. It's similar to what you would do if you bought a car, where you had to put a down payment down for the car and then maybe you had to take a car loan out for the balance. So on July 6th, our company purchases equipment for $16,320. They pay $13,320 in cash and agree to pay the rest next month. So we have in this particular transaction more than two accounts that are affected, but our debits still need to equal our credits. So when more than two accounts are involved in a journal entry, as in this one, we call this a compound entry because there are multiple different accounts affected. So as we see here, our cash decreased by $13,320. So we're going to credit our cash for $13,320. Our liabilities went up by $3,000 because we still owe that company $3,000 that we're going to pay next month. And then our asset office equipment increased by $16,320. So we're going to debit our asset for the full amount of $16,320. So we have a debit to the office equipment and a credit to cash and a credit to accounts payable. And we can see, again, our debits equal our credits. Another transaction, the payment of a liability. In this particular case, now we're paying down that liability we had created, or partially paying down that liability we had created before. So we're going to pay down our liability using cash of $2,600, and we're going to reduce our liability and credit our liability for that amount. So we debit our accounts payable to reduce the liability and credit our cash to reduce our cash balance. Next, we have a transaction where we are recording revenue on account. July 15th, we perform a service for a department store by designing a TV commercial. We bill them for the fee now, but they will pay us later. So we record an increase in our revenue by crediting our revenue, and we record an increase in our assets by recording a debit to our accounts receivable. Next, we have an example of where we record what we call revenue received in advance. We create a liability in this particular instance when we create essentially what becomes a deposit. So when a company gives us a deposit for work that we will perform at a later date in time, we create a liability for the work that we owe them. So in this particular case, on July 19th, we accepted an advance fee as a deposit on a series of brochures that we would design. We received a fee of $1,400. So because we received that cash, we've got to obviously debit our cash to show that we've increased our cash. But because we owe the work to the other party, we have to record a liability. That liability is going to be unearned design revenue. So we're going to record that we owe them that work and create that liability. So we debit our cash and we credit our liability called unearned design revenue. Next, we're going to collect on the account that we had created before, the account receivable that we had created before. So when we collect on an account receivable, we're going to be getting cash in. So we received a partial payment from the customer on July 15th for $5,000. So we're going to record a increase in our cash for $5,000. And now, since they don't owe us as much anymore, we're going to decrease our accounts receivable by $5,000. Next, let's look at an expense that we pay in cash. We're going to pay some wages. So on July 26th, we pay employees for 4 weeks worth of wages. So we debit our wages expense for $4,800 and we credit our cash because our cash is going down by the $4,800. Next, we have an expense that we incur that we're going to pay at a later date. So on July 30th, we receive a bill, but we don't pay it. We receive our utility bill. And that bill is due next month for $680. So we're going to record that we recognize that expense because we've received that bill, but we have a liability associated with it because we're not paying it yet. So we record the debit to our expenses and we credit our accounts payable to show that our liabilities are increasing by the amount of the utility bill. Next we have a transaction where we're paying dividends. Now remember, dividends are not part of the normal operations of the business. However, they do reduce our stockholders' equity and they do reduce the cash associated with the business. So on July 31st, we declare and pay a dividend of $2,800. So we debit the dividend as we would similar to an expense, but remember it's not an expense, it's not a normal part of the operations. So we debit the dividends July 31st and we credit our cash to show that our cash has gone down. And so there's a quick synopsis of the T accounts for all the transactions that we just went through. Okay, and then you can simply answer these questions for Eva's nail salon and show which accounts are debited and which accounts are credited for each of the transactions that are reflected here. You will receive a Google Doc to answer these questions and submit your answers for evaluation. Let's move on now to learning objective number 4, preparing a trial balance. So, a trial balance. What is a trial balance? It is just basically a way for us to prove that our debits equal our credits for a company. So we take basically all of the accounts in that company and we reflect them in the trial balance on the balance side, whatever balance side they're on, and we add up all the debits and add up all the credits to ensure that they're equal. So how do we prepare a trial balance? The first step in preparing a trial balance is to list each account in the chart of accounts with the balance for each debit in the left column and the balance for each credit in the right column. The accounts are listed in the order in which they appear in the financial statements, which typically is assets, then liabilities, then stockholders' equity, then revenues, and then expenses. The second step is to add each column up to obtain the total, and then that total should equal each other. If the debits and the credits are in balance, then the trial balance, if the debit and credit balances in the trial balance are not equal, then you have to look for errors. The first and most common type of error is that a debit was entered in an account as a credit, or vice versa. Another type of error is the balance of an account is computed incorrectly, so you just add up incorrectly or subtract incorrectly. An error is made in carrying the account balance from the ledger to the trial balance, so you double check that and make sure you brought all the correct balances in. The trial balance was not summed correctly, so you didn't add up the information in the trial balance correctly. Or lastly, you recorded an account as a credit when it is usually carried as a debit balance, or vice versa, and this would cause the trial balance to be out of balance by an amount divisible by 2. If that's the case, then you just have to look for where you which account you brought in incorrectly. So lastly, let's just prepare a trial balance using the information listed on this page for Ringo Company. So create a trial balance on the following page, and then again, a Google document will be shared with you to assist you with answering these questions. And that's the end of our notes for today. Thank you and have a great day.